Do you have a significant balance in your retirement accounts? Are you aware that at some point in time, you're going to be forced to take withdrawals from those accounts, which will both increase your taxable income and related income taxes? Well, if so, stay tuned, because in this video, I'm going to be talking about 6 strategies you can use to help reduce your required minimum distributions, or RMDs. Hi, my name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize their taxes as they make the transition into retirement. In the interest of full disclosure, I just want to clarify that this video is focused upon individual retirement accounts only. Retirement accounts can be confusing. There can be different rules for different types of plans, but most plans can be rolled over into an IRA, which can provide some significant flexibility. Just make sure you discuss with your financial advisor to see if that option makes sense for you. Before I dive into the strategies, let me provide a little bit of framework around RMDs and individual retirement accounts. Once you hit a certain age, you're going to be required to take distributions from your individual retirement account. In 2024, those distributions start at age 73. If you were born after 1958, those distributions will start at age 75. Your RMD is calculated using the prior year ending balance of your retirement account divided by your life expectancy factor. Now, the way the life expectancy factor works, the older you are, the larger your RMD will be as a percentage of your total balance. For example, if you're age 73 and have $1 million in your IRA, your life expectancy factor would be 26.5, resulting in a required minimum distribution of just under $38,000. If you were 90 and you had $1 million in your IRA, your required minimum distribution amount would be about $82,000. So what are the general takeaways from this? The larger your account balance is, and the older that you are, the larger your RMDs will be. So now that we know that, what are some strategies to reduce your RMDs? Number 1, taking IRA withdrawals earlier. You are able to take IRA withdrawals without an early withdrawal penalty as early as age 59 and a half. So given that you're going to be forced to take RMDs sometime between age 73 or 75, you've got a good 14 to 16 year window where you can begin strategizing taking distributions from those accounts to reduce those required minimum distributions. There is a conventional wisdom that you should never pay taxes until you absolutely have to. But if you have a significant IRA balance, it may make sense to take withdrawals earlier so that you can reduce the RMDs once they eventually kick in. Number 2, strategic Roth conversions. Now, this is a similar concept to number 1, where we're accelerating income so that we can reduce the tax hit in later years. But if you don't need those proceeds for living expenses, and you were going to put those into, say, your brokerage account and invest them, then a Roth conversion would be an incredibly tax-efficient strategy. Unlike normal investment accounts, activity in a Roth account is tax-free. And Roth distributions are tax-free to you and the beneficiaries who may inherit your Roth account. Finally, you can do Roth conversions before age 59 and a half without incurring that 10% early withdrawal penalty. So if you don't need the funds when taking withdrawals, a Roth conversion may make sense. Now, it's worth noting here that Roth conversions do not count towards your required minimum distribution amount. So the ideal scenario would be to do this before the RMD started. Number 3, delaying taking Social Security. Now, strategies 1 and 2 involved accelerating income into earlier years. One way to possibly offset that accelerated income would be to delay claiming Social Security. I've done a video on the benefits of delaying Social Security, so we won't go into too much detail here, but you can find a link to that video in the description below. But for the purpose of this video, you are able to claim Social Security between the ages of 62 and 70. And generally, the longer you wait, the higher benefit that you're going to receive. So as it relates to RMDs, perhaps it makes sense to wait till age 70 to claim Social Security. But while you're waiting to claim Social Security, you can begin taking withdrawals from your individual retirement account to help you make the ends meet in the meantime. If done correctly, this strategy can do 2 important things. Number 1, it can reduce your required minimum distributions. And number 2, it can increase the amount of Social Security benefit that you are going to receive. Number 4, manage the tax location of your assets. As I mentioned earlier, one of the biggest factors in your RMDs is your prior year retirement account balance. And as your investments grow in that account, the balance of your account just continues to get larger. So you may want to consider holding investments that won't appreciate as much as others. Now this can get a little wonky and is a little bit of a crystal ball situation, but there are assets that historically appreciate greater than others. Think of high-tech stocks like Apple and Nvidia compared to, say, certificate of deposits or treasuries. When you have high-flying stocks in your individual retirement account, all of that appreciation will eventually be taxed at ordinary income rates. And in the meantime, these assets cause your RMDs to increase significantly. So you may want to put assets that might appreciate significantly over time into a Roth account, so that way that appreciation will grow tax-free. Or in a brokerage account, where at least the appreciation of those assets will be taxed at capital gains, and may be subject to a step up in basis upon your passing. So maybe it makes sense to put slower growing assets into your individual retirement account. Again, you're going to want to speak with your financial advisor to see what makes the most sense for you. Number 5, make qualified charitable distributions or QCDs. If you are over 70 and a half and charitably inclined, then qualified charitable distributions or QCDs could be a fantastic opportunity for you. This distribution must be made directly by your IRA trustee to the charitable organization. And the limit for 2024 is $105,000. Any amount made will satisfy your RMD. This is particularly useful for taxpayers that no longer itemize and no longer get a charitable deduction for the charitable contributions that they make. Suffice it to say, this is an incredibly tax-efficient way to both address your required minimum distributions and contribute to charitable organizations that you care significantly about. Number 6, Megabackdoor Roth contributions. One of the best ways to reduce your future RMDs is to never have to be required to take RMDs in the first place. Roth accounts are never subject to taxable distributions, and the assets in the account are allowed to grow tax-free. One of the most efficient ways to get money into a Roth is via Megabackdoor Roth conversion. If you are a high earner and earning more than you typically spend, and are going to invest this amount into a brokerage account anyway, then a Megabackdoor Roth conversion may make sense for you. Unfortunately, not all employers offer this within their 401k plan, but check with yours to see if it is available to you. And if it is, give serious consideration to taking full advantage of it. These conversions have been on the congressional chopping block in the past, so they may not be around forever. So if it makes sense for you and your employer offers it, try to take advantage of it before they go away. So there you have it. 6 possible strategies to help reduce both your RMDs and the related income tax associated with those RMDs. If you have gotten this far, thank you for watching. If you have any questions, please put them in the comment section below. If you enjoyed this content, please hit like or subscribe. Thanks again for watching, and I'll see you next time.